Hi everyone. In this video we are going to continue posting new transactions, and in the previous video we covered transactions A, B and C, and we are going to continue with transaction D. And in transaction D, the company is paying $10,000 toward a note payable that came due. What's going to happen is this is going to reduce the liability item called notes payable, and that's going to decrease by 10,000. Remember, any decrease in liabilities or equity is going to be recorded as a debit, and we are paying for cash. Obviously, for our notes payable, our cash is going to decrease by another $10,000. So whenever you pay your debt, cash is going to decrease, and your debt, in this case notes payable, that's going to decrease as well. And then in transaction E, the company is paying $2,000 cash for interest on borrowing. So we know that it's going to decrease cash by $2,000, and this is interest expense. Retained earnings is going to decrease by the same amount. So this is interest expense, and any expense is going to decrease retained earnings. The last transaction that we want to cover here is when you receive an advance payment for the services you are going to deliver in the future. In this case, the company is receiving cash in the amount of $8,000, so that's going to increase cash by $8,000, and we are going to record this as a liability. Advances from customers, also known as unearned revenue, that's a liability. That a bit bigger. Unearned revenue, that's going to increase by $8,000. Now this transaction may seem counterintuitive. In our daily lives we tend to think that whenever we receive cash we recognize that as a revenue. In accounting it doesn't work that way. In accounting, in order to recognize the revenue, you need to deliver the products and services. And in transaction F, we know that we just received the advance payment and we haven't delivered the services. As a result, we are going to record that as unearned revenue.